What's a tax hack for W-2 earners? All these tax things seems like they're for the super rich, real estate business owners. How about for the high earning W-2 people? Meet Dr. Chen. She's an orthopedic surgeon making $800,000 in W-2 income. Her tax bill is going to be $285,000 of federal income tax. Now, her advisor told her to max out the 401k and a couple other things, but she heard a little birdie whisper about oil and gas. Dr. Chen was skeptical because it's not widely known, it doesn't seem very safe, and the tax deductions they're talking about seems a little too good to be true. Well, what I'm going to do today is I'm going to break down exactly how it works, what the IRS actually says, and some of the traps and considerations that you need to be aware of in order for this deduction or investment to make sense. So let's start with, what are we talking about with oil and gas? Well, there's something called intangible drilling costs. So basically you're investing in someone to go and drill up wells. And when you drill up wells, there's two types of costs. The first one is tangible, real things. Think casing, pumps, storage tanks, wellhead equipment. They have salvage value. You can touch them. The other type of cost is intangible. That's everything else. Think the labor, the fuel, drilling mud, chemicals, the road grading, basically anything that has nothing left to salvage. Here's why I bring up the two costs. Intangible drilling costs make up to 60 to 80% of the total cost of drilling a well. So if you spend $500,000 or invest, then $375,000 of that is intangible costs. And here's the kicker. That cost can be fully deductible in year one. Not a percentage of it, 100%. It's through IRC 263C. Back in the day, the government wanted to spur investments into oil and gas, and so they put a code in place where you can elect to deduct 100% of the intangible costs in the year they're incurred. So let's get back to Dr. Chen. Well, she's going to go ahead and invest $500,000 in a drilling program. She heard it from an investor. She thinks it sounds really safe. And let's see how the math breaks out for her investment. Well, of that investment, $375,000 of it is going to be deducted in year one. And here's the cool thing. Normally, when you have an investment loss or deduction, it's what we call passive, because you didn't go to the site and do the drilling yourself. So normally you can only use that loss to deduct passive gains. Now, here's the cool thing. She can actually use this loss against her W-2 income, making this one of the last true active loss deductions available to high-income W-2 investors. Almost nothing else in the tax code works this way anymore. Now, got a big deduction in year one. So what? How does this actually work? Well, what will happen is they're drilling for oil and other minerals, and hopefully they get oil. And so the risk is that they don't drill any oil and it comes up dry or whatever may happen. But if they get oil in, which is a pretty good chance, then you're going to get quarterly distributions from that investment. And of those quarterly distributions, you can take what's called a depletion deduction, another code in the IRS to spur investments into oil and gas after she deducts the IDCs in year one. Once the well starts producing, if it starts producing, she gets a second deduction on the production income. It's called percentage depletion under Section 613 and 613A. As an independent producer, which individual investors are, she can deduct 15% of the gross income on the well, subject to some production volume limits and a cap at 65% of her taxable income. So the tax code gives her two bites out of the same apple. Deduct the drilling costs up front, then deduct a percentage of the income when the well starts to generate income. This combination is why oil and gas remains one of the most tax-advantaged investment categories in the code, hands down. Now, Dean, this sounds amazing, sounds really cool, but what are some caveats? Well, The first one is going to be that it's an AMT preference item. Now, you regular people probably don't understand this, but it's alternative minimum tax. Basically, if you are evading or mitigating your taxes too much, then you have to pay, right? And so what you need to do is have your accountant map it out to make sure that the tax savings is greater than if there's any AMT implications. On a second note is that the investment needs to have liability on you, the investor, meaning you can't structure it through a limited liability corporation or a limited partnership. You have to be at risk with that money, no exception. Also, you can't borrow the funds, you can't do anything weird like that. It needs to be your cash, your investment. If someone is selling you an oil and gas investment and the only thing they talk about is the tax deduction, might be a little sketchy. Now, you need to actually map out the investment itself and make sure they're not overly leveraged or bad track record, whatever it may be, and make sure that the tax deduction and the investment make sense for you. Now, this is just education, not tax advice. Every situation is different. You can talk to an enrolled agent or a CPA or tax attorney before making any investment decisions. If you guys stuck around for this video, go ahead and hit subscribe. You wouldn't be opposed to that, would you? We got more content coming your way and cool videos about how to maximize taxes and optimize during the AI age.